Hi, I'm Rick Kaler. Thanks for joining me. In mid-May, the S&P 500 hit its eighth consecutive weekly gain, and the Dow Jones Industrial Average hit a record close 2 days in a row. In that same week, the University of Michigan reported that its index of consumer sentiment fell to the lowest level ever recorded in more than 70 years of surveys. How is that possible? How is it possible that consumer sentiment is at an all-time low while stock prices hit all-time highs? This disconnect is not what usually happens. Stock prices and consumer confidence tend to move together because they draw on the same conditions. A growing economy where people are working, earning, and expecting more of both. In 40 years as a financial advisor, I've never seen a market this confusing to investors. Now, there's an old adage that the stock market climbs a wall of worry, which describes its ability at times to keep rising during negative economic news or events. This defies logic, yet I've watched it prove true time after time. In addition to pointing out the S&P 500 and Dow Jones highs, a May 26, 2026 article in Yahoo Finance by Kok-Fu Nijin also mentions Yale economist Robert Shiller's cyclically adjusted price-to-earnings ratio. Now, I know I'm getting in the weeds. Hang with me. And this ratio smooths out short-term earning swings. Now, it currently stands at 40 times the S&P 500. The only other time it closed above 40 in 145 years of data was during the years surrounding the dot-com peak in early 2000. This was also when consumer sentiment reached its all-time high. Today, it's reached its all-time low. Does this make any sense? Well, it might, according to two other professionals in Nijin's circle. Joanne Su, Director of Consumer Surveys at the University of Michigan, notes that sentiment was already fragile at the beginning of this year. Given high prices and a labor market that has weakened over the past 4 years, and adding into that the war with Iran, which has sent gas prices sharply higher. When you add all that together, no wonder consumers are pessimistic. Robert Barbara, Director of the Center for Financial Economics at Johns Hopkins University, offered three possible explanations. First, stock prices may be out of touch with economic reality, and consumers are correctly sensing trouble. Second, stocks may be foreseeing a recovery most Americans are not imagining. One in which the war ends, inflation eases, and growth returns. Third, both may be responding in opposite ways to the belief that AI is a complete financial game changer. Now, it's possible that all three factors make sense. AI has driven much of the recent market enthusiasm. Companies that can use it to cut labor costs and expand profit margins look highly attractive to investors. But a world where businesses sharply reduce their need for workers is not one where most employees feel secure. Consumer surveys may well reflect anxiety about whether AI will eliminate the jobs people already have or close off the ones they hope to get. As a consumer and an investor, what should you do? My recommendation is the same advice I've offered for decades. If you hold a globally diversified portfolio with a balance of stocks and bonds appropriate for your circumstances, just leave it alone. A recession will come. The market will correct. It always does. But investors who lighten up on equities at any point in the last several years left significant returns on the table. So I suggest you rebalance, stay diversified, and resist over-focusing on financial news and investment account balances. Trust that the stock market has always climbed its wall of worry. It's climbing one right now. You don't have to let your anxiety climb with it. Thanks for listening.